Hi, everyone. Thank you for joining. We will be starting in about 3 minutes to allow more people to log on here. And just as a reminder, this will be recorded and should be sent out to everybody within the next couple of days by the end of the week. Thank you. Hi, everyone. Thank you for joining. We're going to wait about 1 more minute to allow a few more people to log in here, and then Karina will get us started. Thank you.
Hi everyone, I'm Karina Akidal, Managing Editor of Canadian Auto Dealer, and welcome to our 4-part webinar series, Steady at the Wheel, Leading Your Dealership Through Business Recovery. This is the third webinar of our 4-part series. Today's webinar is in 2 parts with 2 different speakers. In part 1, we'll be hearing from Steve Hall from NCM Associates. He'll be presenting on revolutionizing the parts and service department. In part 2, Corinne Drever from MNP will present on preserving cash through effective tax planning. The timing could not be better for these 2 topics, and as in certain provinces, the parts and service departments were the first to reopen after a period of tough lockdown measures. And as we know, there is money to be made in this area, but innovation and optimization will be needed to better meet the needs of consumers and to boost revenue. Similarly, the importance of preserving cash for the sake of saving and being able to innovate in other areas seems more important than ever. Tips and advice on effective tax planning can help dealers better plan for the future, however uncertain that future may appear to be at this moment. But before I throw it over to today's presenters, there are just a few housekeeping items. First, today's webinar will be recorded, as Alex mentioned, and it will be sent later this week or early next week. Next, we will be taking questions from the audience at the end of the webinar. You can submit your questions at any time by clicking on the Q&A button at the bottom of your screen. You can enter your questions there and I'll do my best to ask the experts. If you can't find it, you can just move your mouse to the bottom and it should appear at that point. Now it's my pleasure to introduce today's first speaker, Steve Hall. Steve is a full-time instructor with the NCM Institute, using expertise honed during more than 25 years in the automotive industry. Steve is responsible for the Institute's fixed operations curriculum. He was an equity partner in 2 dealerships and held management positions in all areas of auto dealership fixed operations, including service and parts director and vice president of fixed operations for more than 19 stores. And with that, Steve, I'll turn it over to you.
Thank you, Karina. I appreciate the introduction. I want to welcome everybody to today's webinar. I know you have a busy schedule, so we're going to jump right in here. In case you missed the first and second webinar series with my coworker, Bernie Clement, and David Kane from Kane Automotive on this, I wanted to just touch briefly on NCM and who we are if you're not familiar with us. We have 4 primary divisions. The biggest one is the one you probably know the best, our 20 group division, which is our peer learning and collaborative team building numbers review with this. And you probably know us partly from the concept version of this, which is a company we acquired a few years ago that's had a very large presence in Canada for many years on it. We also have an in-store consulting services with a full range of consulting items with it. We have the NCM Institute, which handles the education and training. And we have the Business Intelligence or Software Solutions Division, which you may know through Core or Echo, along with Accessa, Health Check, or other software offerings that we have. Ultimately, though, we are a data company. We've been around for a long time, since 1947, and we have a lot of data, and we find unique ways to share that. With that in mind, I'm going to jump right into today's material. So today, I'd like to first mention or show some information on how the recovery is progressing. We're going to look at 4 key metrics on this. The first one is going to be retail repair order counts. The second one is going to be retail gross per service advisor. The next one will be total gross per technician. And the last one is going to be service operating profit. After we review these slides and this data, then I'm going to talk about some ways that we can affect this with it. So with that being said, I want to launch a first poll here, and I want to ask about service traffic and how you feel about the service traffic currently. So how does your service traffic compare to your pre-COVID levels? Are you lower by 25% or more, lower by 10% or more, equal, greater by 10%, or greater by 25% or more on your traffic? So we have several responses coming in right now. We'll kind of give this a second for everybody to jump in, give us their information, and then we will go from there. Okay. Got a few more answers coming through, getting a pretty good balance right now between things, a little bit on the lower side. So we'll see where this ends up. Okay, so we're gonna share the results here. It looks like about 13% of you are lower by 25% or more, 33% ties for being lower by 10% or equal to pre-COVID times, and greater by 10%, only 21% of you are, with nobody saying that they're up 25% or more with that. So that being said, let's just jump right into some of the data and take a look at this on it. So as we go into the next slide here, we're going to show a chart, and it's actually going to pull up a lot of data on it. And I want to be careful, and I want to just kind of focus in on a couple things here with the time that we're looking for. First of all, is we are looking at Canadian benchmark dealers, and our benchmarks are set where we take all the reporting dealer data to us, and then what we do is we take the average of it, which would be Canadian average, and then we take the average of the top half to set our Canadian benchmark. This is represented for 2019 versus 2020 in this red circle that I have up on the screen. The blue dot in the center of that is the 11-month average. We do not put into December into this average we're looking at because some of the accounting, the way it flows with that. So this is the 11-month average RO count for 2019 in that blue dot. And then you can see May 2020 in the orange, June 2020 in the gray, and July 2020 in the goldenrod over here with that. And what we're trying to do is we're trying to see how does this really compare to last year with it. So as we move forward on this, we can look at the blue circle, and this is actually the same type of data, except it was the year prior. So we're looking at 2018 average is the blue dot inside the blue circle, and we're looking at May, June, and July of 2019 in the blue circle. What's interesting about this is you'll notice in May of 19, over here on the left side in the blue circle, you'll notice that we had the big push on RO count, and then it dropped in June and rebounded in July. Well, obviously we had tire changeover going on there. If you look over at the red circle, you can see we didn't have that this year, partly because of lockdowns and various other items going on. That got pushed. We would have expected that to have gotten pushed into June and July, but as you can see, that really hasn't happened. Matter of fact, if you go down to the bottom of the slide and look at the blue arrow, we can see a disturbing thing here where July last year was at 609 for Canadian benchmark dealers and dropped to 544. Now, the bigger concern is if we look right above the 544 by the blue arrow, we actually went down from June's 557. So we're seeing some inconsistency on this. It's actually choppy at best as we're looking forward. So whenever some of you are saying, hey, we're down by 10% or maybe we're equal to it, this is kind of what we're seeing right now. It's actually we're seeing most of them are down even on the Canadian benchmark dealers with that. So what does this say to me? Well, it says that our customer paid transaction counts are just struggling. We've got to find a way to work on customer retention and try to improve these counts and bring them back up in the current marketplace. The kilometer patterns have been disrupted, possibly by the new normal of work from home or remote work that we have with this. And we've got to find a way, if we can't get as many visits due to the kilometers being driven, we have to make absolute sure that we are increasing our retention in order to get our counts back, okay? So let's go ahead and move forward and look at a couple more charts here. The next one I want to take a look at is service retail gross per advisor. This chart is set up the exact same way as the prior one was. So over on the red circle, whenever we're looking at that, we're looking at the benchmark dealers. The blue dot in the middle is the November 11-month average for 2019. And inside the red circle, the orange is May 2020, then gray is June 2020, and then the goldenrod is July 2020. And you'll notice that our retail gross per advisor is actually dropping some through May, June, July. But if you compare it to the blue circle over here, we can actually see that we've had quite an increase over the previous year in this. So even though it is coming down, we actually have an increase. This is also illustrated by the numbers below. And if we go down to the very bottom blue line here, we can see that we went up from July last year at 23,800 on service retail gross per advisor to 28,800. So that's a nice increase. The concern is that right lower blue oval where we went down from 31.7 in May to 31.1 in June to 28.8 in July with this. So as we start looking at this, we have to decide what is causing this change on it. Now, we think that the increase could partly be due to a reduced advisor staff. As we had layoffs, whenever we have, even if we have less gross profit, if we have fewer people that are producing that gross profit, their average per person can actually go off. And as we track personnel counts, we actually did see a reduction in advisor staffing. So it's one thing to have increased production per person. It's another thing to actually get growth back into the department on this. That may be one of the reasons that we have the little decrease happening right now. Could be because you're bringing more people back from the layoffs, which is decreasing that pool, and we haven't increased our repair order count in order to overcome that. Now, another thing we're seeing on this is our transactional dollars have actually increased along the way on this. We saw fewer people coming in for oil changes and minor services. Some of those were being pushed out due to the lack of driving. And so what we saw is that the repairs did come in, and the transactional dollars per repair order actually increased along with effective labor rate. We want to be cautious of this falling below past performance as staff has increased. So even though we see this coming down, we still want to make sure we're staying above traditional gross per advisor as we move forward and as we grow back in our departments on that. So now let's go ahead and take a look at the third metric that I want to put up here for today. And this is the total gross per technician. So it's kind of similarly related to the gross per advisor. But on advisors, we were only looking at retail gross, whereas on this slide, we're looking at total gross. So this includes warranty and internal along with that. And as we move through some of the data here, if we look within the red circle, the blue dot was the total gross per tech for 2019, the 11-month average. And you can see in May, we actually started out down from May of last year, but we increased in June and we increased in July. So this is the pattern we like to see as we're coming back. We're actually getting more productive along the way as you compare this to the left-hand side, the blue oval, and you can see the trend last year, obviously with the tire changeover in the big May, and then the drop off and rebound back. But whenever we go down to the bottom of the slide, what's really nice to see is if we just look at July 2019 versus July 2020 data, we can see that we're actually up about $1,300 per technician on this. So we're getting more productive along the way that this is implying. Now, it comes back to that same equation that we had a while ago. Well, what about the employee counts? Did we go up in gross per technician just because we laid off lower wage technicians or lower productive technicians and it caused the average to go up? Well, in our data on this, the technician counts have actually stayed consistent. And this goes right into the thought of you only have so much availability of hiring these productive technical people. So I know that dealerships did everything they could to keep their technician staff and count on and employed. We may have had a little turnover with some low end or attrition on the low end, maybe the maintenance techs, oil change techs, but the overall count stayed very consistent. So that's a real good plus where we see the gross going up per technician whenever we didn't see the RO counts. Some people say, well, how did that happen? Well, part of this comes from increased gross per technician from warranty and recalls. One thing that dealers did a very good job is they started going out and really attacking the recall list and pushing for warranty to try to get these vehicles in. Not selling warranties, we wouldn't want to do that with the manufacturer, but pushing for the recalls on it, which fall under the warranty category on the financial statement on this. One thing we want to be careful of going forward, though, is that we have the efficiency gains in order to continue the pattern of the gross per technician going up. Part of this could be what really allows the bounce back to happen, or whether it drags out longer on this. Because technicians are so hard to find, because technicians take so long to train, we're going to have to continually find ways to make our technicians better and more productive. We've got to keep that surgeon in the operating room operating every minute possible and keep the workflow coming through them. So we've got to work on the efficiency gains, which we're going to talk about here in just a minute. So before I get into this fourth metric here, I'd like to pull up another poll. And this one here is going to do with profitability. So I want to know, how does your service department profitability compare to your pre-COVID levels? Lower by 50% or more, lower by 25% or more, equal to pre-COVID, greater by 25%, or greater by 50% or more. So we'll give a few seconds here for everybody to give their answers. Okay. We'll just give a few more seconds here. Okay, very good. Okay, let's go ahead. We're going to share the results on this. Good news is nobody's saying that they're down by 50% or more, so that's good. We have 15% saying that they're lower by 25%, 67%, the vast majority, say that they're equal to pre-COVID levels on profitability. 15% are greater by 25%, and 4% are actually saying that they're up by 50% or more with that. So very good. Well, how does that relate to the data that we are looking at here? Okay, so on this next slide, what we're going to look at is service adjusted operating profit for 2019 versus 2020 on this. And as we look at the red circle, the nice part of this is we've seen increased profit all the way from May, June, July, not just a little bit, but very substantial increased profit along the way on it. So it's encouraging to see that we, even though we're down in RO count, even though we may be struggling on some customer pay, we've increased technician performance, we've increased technician efficiencies on this, and we've been able to drop that through to the profitability on it. And if we look down at the bottom blue line with the arrow here, we can actually see July of 2019, Canadian benchmark dealers did $31,813 in service operating profit, where this year they're at $50,807. So they were actually up a full 60% increase, and this was a real progress. So those of you that are saying, hey, we're back at our pre-COVID levels, or we're sitting here and we are maybe up slightly, down slightly, we have to realize the benchmark dealers, the top half of the top half, are up substantially. And actually, even though it's hard to read on this slide, if you look under the blue line on the Canadian average on the left, it's 16,351. The Canadian average dealer went up to 21,489. So that was over a 20% increase in net profit along the way, or operating profit along the way with that. So what does this mean to us? Well, first of all, you did a real good job of adjusting to the situation and handling the situation that you have. Expense reduction was the first action taken by everybody. And as we know, if we reduce an expense, that falls through to the bottom line, dollar for dollar. So we got really good at that. Of course, some of the government programs for payroll and various things that way helped us be able to take those actions. And we also got very good, not just at our personnel expense, but looking at everything else, reoccurring expenses, contracts, outside services, everything that way. Expense reduction was really a big part of that increased profit. Now, as business returned, though, dealers kept the expenses down. So over the last few months, you can see that profit continues to increase as you brought back gross profit from the lockdown ending and building some business back. And we actually saw that come to the bottom line. What's interesting is this does not match the repair order counts for retail repair orders. So just think about this. What can happen to our profitability if we continue to keep our expenses in line, if we continue to build the business back, and we get the RO counts to match? And also our employees were willing to accept higher expectations, which helped this profitability along the way. They were glad to be employed, the ones that were still there with it. Their attitudes changed, and some of the prima donnas or some of the people that possibly weren't putting forth their best effort on every day in our staffing, they were more willing to jump out and to do a better job for us because they knew it was beneficial to them. So what does this mean to us? Well, I'm going to look at 3 different areas of possible opportunities. And we have to ask ourselves, what changes have happened that have created opportunities to improve our business? And there's 3 main topics I want to wrap up on today. The first one is the customer processes or standards of convenience that they expect these days. The second one has to do with staffing and production. And the last one will be the sales transaction with that. So on the customer processes and standard of convenience, I want to think about some of the things that we've had opportunities on and we may have made progress on. The question is, will we continue to progress forward with this? Everybody's talked about pickup and delivery of customers' car. We did this out of a need from the lockdown. We did this out of a need from keeping people out of our lounges and social distancing on this. We did this out of a need just to drive people to our business where we could get business done, where maybe they were afraid to come in, or maybe they were a high-risk person for catching the disease and they just didn't want to get out, but they were willing for that. The question is, are you actively pursuing this opportunity or not? This is a real opportunity. And whenever we say that, is sometimes ownership will say, we want to do pickup and delivery. Whether you use a third-party company, whether you do it in-house or some other means with this on it, they say, we want to get after it. But then sometimes there's a disconnect where the service manager, the service employees maybe don't buy in fully on getting it done. They see this not as a need today, but they see this as a burden in the future where maybe we just don't have the manpower and the personnel in order to continue doing this down the road. So we don't want to really start it, and they're actually kind of holding back. So my question is, what is your communication tools for this? Are you using this as a real retention tool? Do you realize whenever you go and you pick up that oil change customer and maybe it costs you, as much profit as you'd make on that oil change just to send people over and pick up and redeliver that car? But how many times do we take that $50 repair order and turn it into a $1,500 repair order? Or maybe it's not at a point where that happens, but we're keeping that customer retained. And so that whenever they do need those tires, brakes, alternator, battery, whatever it is, they come to us along the way. We have to use this as a retention tool and a marketing tool to keep them coming to the dealership, or keep their vehicle coming to the dealership, even whenever they don't feel that they can make it there on it. Also, this can improve the flow of vehicles through the shop. Whenever we're talking about the increased gross per technician, we have to think about this along the way. This reduces waiters when we do pickup and delivery, and we can actually plan out how cars come in. Rather than everybody showing up at 7:30 or 8 o'clock in the morning, and we have this feast or famine, we can actually, with pickup and delivery, plan out our work day for improved workflow, which will actually make our technicians more effective than ever before. Now, this could have possible effects on tire changeover, though, with this convenience and the customer standard of convenience change and what they expect, whether it's groceries delivered or other e-commerce ways they do business. Their standards of convenience have changed. This may actually put into an effect where whenever we have tire changeover, they actually expect it to be done mobilely now going forward or not. So it's something to look at. Is there an opportunity or not? Digital presence on this, on the standards of convenience for the customer continues. The stay-at-home shopping patterns have absolutely set in. People like buying from their couches. So what does your website look at for service? Do you have one of the tile slides that scrolls across the top and flips in? Are all 7 of those tiles about your financing and your inventory and the latest manufacturer program? Or do you have anything on there about your service and appointment ease? Is your appointment ease of availability accurate? Meaning whenever they go into your website to set an appointment and do this digital shopping that they're used to doing now, do you have the first appointment available truly showing up on there, or is it locked down for 2 or 3 days so that they can't get in for 2 or 3 days, which should actually drop them out of out of their shopping experience with that? And lastly, transparency of pricing on this digital presence. Your menus and time and kilometer based services on this need to be priced. You need to make sure that you have a better presentation flow of your menu and the way that the appointment goes through this, where it's not just you ask the customer to put in their vehicle and then you ask them what they need and they click on oil change, tire rotation, and then they go to the next appointment. You need to have it where it picks up their exact mileage and it says, okay, you're due for your 30-kilometer service, or whatever that time frame is, time and a kilometer based service is, and that comes up, but it has to have pricing. If it ever says see your advisor for pricing or call for information, they will click past it. You've got to get your pricing on this. Think about it. You wouldn't go onto any of your e-commerce sites and buy an item if it didn't have pricing on there. And if you're not proud of your pricing, we need to make sure that you find a way to put it where it does come across, because everybody out there tries to value price. We need to communicate with it. And lastly, on the customer processes, we need to have the e-payments option, both for active delivery and also for payment itself. A customer should be able to do a complete transaction with your service department without ever needing to see you. If we make this right, this can stick and pick us up business going forward. So on the second one here, let's go to staffing and production. So we need to be sure we reset the levels of expectation for all of our staff on this. They need to understand it's not business as usual, that we expect more out of people. We have to have more out of people as we're changing and moving forward in our processes and expectations. We want to have a reduction in downtime of productive employees, specifically technicians on here. Technicians should have parts delivered direct to their bay to keep them in there and out of the parts department. Parts department, you can really help out on this on efficiencies with that. Pull any parts you can, have electronic parts requests, keep them in their bays working, turning wrenches, producing hours. Express parts should be stocked in the express bays if you aren't. While you had this slowdown, this is the time to get really good at these 2 items. We should get better at our dispatching and workflow and matching up the right tech to the right job so we can get the speed and efficiency out. And also watching our daily appointment capacity. This is one of the challenges that we have as we go, especially on pushing digital appointments or online appointments more, is our appointment capacity. If we're pushing more recalls than before, and let's say we have a capacity of 50 appointments a day as our basis, and maybe that equates to 90 hours a day we're trying to book. Well, there's a big difference if 40 of those 50 appointments are customer pay and 10 are warranty, versus if we're pushing the recalls and all of a sudden we have 15 warranty appointments on this, and to get to our 50 or to get to our 90 hours on this, we only book 35 customer pay. Our customer pay counts will naturally go down, so we got to make sure we're increasing our appointment capacity going forward with this. There's a balance between staffing ratios. We want to make sure that ideally we're looking for 3.5 technicians to 1 advisor. The range of that is 3-to-1 to 4-to-1, with the sweet spot 3.5. Too many technicians per advisor, and the advisor can't sell enough work to keep them busy. Too few techs per advisor, and as soon as the advisor sells the work to keep their technicians full for the day, they will stop selling at that point. They will cap their hours available because they can't get it done. They don't want to carry the work over. So we want to make sure that we're really watching it as we bring people back. And we want to make sure our support staff comes back based on business assessment, meaning if we had to trim our support staff, whether it's porters, appointment setters, BDCs or such, we want to make sure that we bring those back, not just because we think we're coming out. We want to do a business-based forecasting and planning and make sure we're growing the business, or else those expenses that we did such a good job of reducing for profit, we will give right back going forward, and it will not stick. So the last part of this is the sales transaction. We want to watch our RO counts, or actually VIN transactions per advisor per day, as we build back. And we want to make sure that our advisors are slowing down to perform at a higher level. Our advisors have 3 times in order to present to a customer. the initial request, which is whenever the customer contacts us by phone or digital, or they just drop in on this, we should have a 100% close rate on those requests. But if we don't answer our phone effectively, if we don't have a good online appointment system set up, or if we turn people away whenever they drop in without an appointment, that's going to hamper our recovery with this. The second time they have to present is the in-lane presentation, which is the time and kilometer-based service intervals. And if we don't have a great menu, electronic menu, tablet, whatever we're using, you can use paper on these, and we don't present that, we're missing out on sales. And the last time we have to present to the customer is after our in-bay process with our multi-point inspection and the additional service requests on this. And we owe this to the customers because they want fewer visits. They don't want to have their car picked up or bring their car in any more than necessary. So anything that's going on with that car, we need to be able to catch and tell them right now, and so that we can try to get it done. It's going to help our sales per ticket, and it's going to help the customer peace of mind of their vehicle and how often they're coming in. Whether it's digital or video MPIs, whether it is better communication throughout the whole process, we have to look at this. But part of the problem is whenever we cut some of this staff, we have to take a look at what our advisors are actually doing. If our advisors were not taking inbound phone calls prior because we had a appointment setter or BDC doing that, and then we cut that staff and now they are, we have to realize the number of ROs they can write per day is going to take a little bit of a hit to do it quality. And if they don't slow down to perform better at each of these three opportunities with the customer, what we're going to do is we're going to trade number of transactions for the dollars that we are getting per transaction. So we want to slow down and make sure that we're building this back properly. So to kind of wrap this up, I want to explain, this is a unique opportunity. It's really a generational or beyond. Some people call it a 100-year opportunity with this. And even though it's been a challenge, there is opportunities with this when you dig into it. It's going to separate the forward movers from the average dealer. Now, I didn't say forward thinkers. Forward thinking is you're looking into the future, you're trying to see how to do things better, what customers want, what we can do to meet their needs and to gain them. Forward movers are the ones that take that forward thinking and put it to action and actually make it happen. Or just thinking about it, they make it happen. Those dealers are going to go leaps and bounds above the average dealer. That's one of the reasons we saw the Canadian benchmark dealers up 60% on profitability for the service department. They were moving and taking action on these. So we want to look at what works and build upon it as we go forward. We want to make sure that if we have a failure on something, we kind of tweak it, try to move it forward and make it better. Something that does work, don't ignore it. Let's keep trying to make it better and make sure we don't fall back into the old routine of business as usual. This is one of those times that we have where we have this unique situation to change things and really make a positive impact on our customer. And the last thing we want to do is 60 days from now, 90 days from now, sometime in the very close future, you look back and say, what are we doing today versus what were we doing pre-COVID? And we say, we're doing the exact same thing. It's got to be different. We've got to make this stick. So that being said, I want to thank you for joining me for today for this segment of the webinar. I'm going to turn it over to Karina now for the second part of today's webinar. Thank you very much.
Thanks, Steve. Great, a lot of good advice and great reminders for dealers. So just a reminder to the audience, if you can ask questions through the Q&A button at the bottom of your screen at any time during the webinar, and we'll get to those questions after the webinar. So next up is Kim Drever. Kim is a partner and the regional leader of MNP's Tax Services Group for the Edmonton region. Kim specializes in Canadian corporate reorganization and tax planning for businesses and their stakeholders. She is currently serving on MNP's board of directors and its tax executive committee. So Kim, with that, over to you now.
Thank you. So today we're switching gears a little bit. We've talked a lot about efficiency in operations, and we're going to now look at some of the efficiencies with respect to your tax planning and your cash. So this morning or this afternoon, depending on where you are, we're going to be talking about ways that we can preserve cash in this time, using depressed fair market values to your advantage, some of the structure planning that you might want to look at to create some tax efficiencies. And we'll spend just a little bit of time at the end just looking at what do we think is going to be the future of tax in Canada. So with respect to preserving cash, the first thing I want to remind everybody is that there was an installment deferral that had come into play. So because of COVID, we had a deferral of our installments until September the 30th of 2020. So those are going to be coming due at the end of this month. If you have already an installment base and your income isn't at your last year's actuals, we should be recalculating what is actually going to be required for this year and be remitting based on that instead of last year. If you have already paid much more in than you want to pay in because you aren't going to be needing that amount of tax base for this current year, we could be looking at recovering some of those installments as well. So I'm looking at this from a few different aspects. So in the current year, what should we be looking at? One of them is to make sure that we're always looking at the collectability of our receivables and allowing for our doubtful accounts. So having sound receivable measures in place to ensure you are collecting what you need, but also looking at this critically at the end of the year. And if there's anything that's doubtful, we should be taking the deduction against it so that we're not paying tax on that income. Secondly, we should always be reviewing and adjusting our inventory levels down to the market value. So if you have anything that you're carrying on the books at higher than your current value, we should be deducting that in the current year. And one thing around employee compensation, we always know that we can, pay our employees bonuses and commissions, and they can receive their base pay as wages. But there's other things that we can look at. We can look at employee share ownership plans or phantom stock plans, and that essentially takes part of the remuneration and it turns it into future value for shares, or it turns it into future payouts based on appreciation and value of the company. So those are some of the things that we could be looking at this time as well. They're great for retention and it helps you with your cash management. The government programs is something to look at. So the CEWS is one I just want to talk about briefly today. This program was extended to November the 21st of 2020, and with a ability to extend it all the way to December 31st if the government so chooses. When this was extended, there was a lot of changes that were brought into the program to make it more meaningful. And so now the CEWS can apply for every business or every eligible entity with any kind of a revenue decline for periods 5 onward. So if you historically looked at this and thought, well, I don't meet the 30% revenue decline test, I'm not eligible, you can get the CEWS now at less than 30% revenue decline. So there's a sliding scale for revenue reductions. The most impacted entities are going to have larger percentages of the subsidy than the less impacted entities, but everyone can get something. If you are above a 50% revenue decline for the qualifying periods, you can have a more significant CEWS claim up to 85%. Below 50% of a revenue reduction, the subsidy is actually tied to your revenue reduction. And this program is now going to be phased out over time. So one of the things that we were very concerned about when we were called as a witness for the House of Commons Standing Committee on Finance on this, we did talk about our concern that there was going to be this drop dead date, if you will, when all of a sudden the program ended and people were left saying, now what? Do we lay all of our employees off? So the phase out is a good thing that's come into play. So I do have a poll question here. And so what we're curious about is, have you applied for the CEWS for your business? I'm sorry, just waiting a little bit longer. So 100% of the people that have answered have applied for the CEWS, and I'm really happy to hear that. And everything that we have seen, it came through quite quickly. And we do know that the audits are about to start on this. So 100% have applied. So, sorry, I just had a little bit of trouble with my mouse for a minute. For the CRA audits, what do we need to retain for these? We're going to need to retain all calculations of revenue reduction. So we're going to need to know exactly what was my historical revenue, what is my current period revenue, what is my computation method, so I can be able to compare and contrast those. I'll need to have details on any and all elections that we claimed. Your banking documents, so we'll need to see exactly what went in, what was received. So the CRA will be asking for all banking documents. They're going to be asking for details on proof of employee payment. They're going to be asking for details on proof of wages and salaries by week. And so there's going to be quite a bit of detail that's going to be required as the audits begin. And we had always expected them to begin in September. There's also, with the Qs, we should know that there is some penalties attached to this. If you are overpaid, if you overclaimed, there's going to be some repayment of the Qs that you've already received, and that's to be expected. There's also a penalty on top of that if you have done something that artificially suppressed your revenues. So that penalty is another 25% on top of the amount that you would be repaying. One of the things that's very interesting in this piece of legislation is there was the ability for the minister to share names of the recipients of the Qs, and there's a few schools of thought in terms of why that was. Some people think it was so that you would only apply if you really were legitimate, and I think that there was probably a lot of merit to that. I also think it was also so that the government could say, look at even, and I'm not saying anything that we don't know, look at even Air Canada applied for this. So I think that there's a lot of, it was about goodwill, creating goodwill. When you have a Qs claim, you're going to have an income inclusion for tax purposes in the qualifying period. So it's not when you actually claimed it or when you received the cash, it's in the qualifying period that is covered by that Qs claim. And to date, on the website, we can actually go in and see the amount of approved claims and how much money that's been. So to date, the government has approved $33.7 billion of claims for more than 1 million applicants. And the highest claim period was from April 12th to June the 6th. The other thing to note is when this was first brought out, it was supposed to be an $82 billion project, and the parliamentary budget officer now says it's about a $56 billion project. So let's look at depreciation. So if we buy assets, what kinds of things can we do around that? So right now we know that interest is cheap. And so if there's anything that you need to do to create efficiencies, if you need to be using this period of time in order to buy new assets or building new or doing major renovations, there's no time like the present if you have access to the capital and the interest is at 1% or at 2%. So for any asset additions that you have, just remember there's an accelerated CCA for deduction purposes, so you can write off it at a much faster pace than historically. And if you are building new, consider setting up a holding company to hold the real estate and have it leased to the dealership. When you lease it to the dealership as a shell. And what you do is you have the landlord company and the dealership. The landlord company builds the building and it leases it to the dealership, and the dealership does all the leaseholds on the building. So everything about fit and finish is done by the dealership. And what that does is it changes my depreciation rate on the building from 6% up to 20% on leaseholds. So that's a significant tax savings if you're going to be doing the funds anyways, going to be doing the purchase anyways. So some of the things around estate planning, it's also might be a good time to look at different planning options. One of the first things is if you currently have shares or investments or even shares of your operating companies that have appreciated in value, just remember the current inclusion rate for a capital gain is at 50%. So what that does is it allows me to effectively have taxes paid at, 24% in Alberta, up to about 26, 27% elsewhere in the country on a capital gain. So really what we could do is we could lock in the current tax rates by creating capital gains on any kind of appreciated assets at this point in time. If we suspect that capital gain inclusion rates are going to increase, or if we suspect that tax rates are going to increase, it's a way to create certainty right now and essentially accelerate tax, but you are locking it in at lower rates. You're also doing it under today's rates and under today's laws when we know exactly what the rules are. Other things to look at for estate planning, for retirement planning for the dealers, things like individual pension plans, that's an IPP. You can set up pension plans. You can set up retirement compensation arrangements. These are things that can get used and they can have a lot of value for different businesses. Also, any types of life insurance policies, remember here, these can be great things to use to equalize estates, and exempt policies have a cash surrender value attached to them. So there's an investment component. We could consider leveraging that portion to get capital back into the business if need be. So one of the things that Steve had said is that right now we have a 100-year opportunity. And so I've always said that, a recession is a terrible thing to waste. So how can we use some of these depressed fair market values to our advantage? So if you have assets in the company that you would like to remove out of the company and they're worth less, the gains are less and you'd like to get them out to the shareholders levels or different things like that, now might be a great time to do that. Now is also a good time to look at freezing or doing a refreeze to reset preferred share value. So really, if you are looking at transitioning a business to the next generation, to family members, even to employees at less than fair market value, we might be looking at doing things where we do that now. So we can establish our transaction value at today's depressed value. If we do a freeze or a refreeze, or even selling to employees today where we want to do something less than value, what that allows me to do is it minimizes the value of the assets at the time of death. It decreases tax on terminal returns. And it also allows me to bring in new people as shareholders while allowing the people that I want to have control, to maintain control. So a freeze or a refreeze or any kind of a transaction to include employees, whether it's an employee share ownership plan, depressed values are the right time to be doing that. Looking at some of the structure planning to create some tax efficiencies. So if I look at any kind of business combination to use losses, I want to preface this discussion by looking at what happens if I use two companies. So if we have two operating companies in our corporate structure, let's say I have two dealerships, one is operating at a profit and one is operating at a loss. If my profit company has profit of $1 million, I'm going to be paying tax of approximately $250,000 on that income. If my loss company has a loss of $1 million, that loss can get carried forward, but what it can't do when I'm using a corporate structure is using it against the profit of the profit company. So I just want to touch on a couple of options out there in terms of dealing with, trapped losses, or where I have an entity that's creating losses and one that's profitable. So looking first at the permanent solutions. Permanent solutions would be amalgamations and wind-ups and things of that sort. That would be where I actually amalgamate the two entities together. A lot of the times we don't like doing that, especially in dealership situations, because we don't want to be commingling the different companies together, the different locations together. So amalgamations, wind-ups can be good in a lot of situations. It's less viable normally in a dealership situation. One of the permanent solutions that can be quite well used would be a partnership structure. So what we would do is, rather than operating through corporations where losses get trapped and income is taxable in that entity, if we used partnerships and we had a limited partnership for each of the different dealerships, if one is in a loss, we can essentially plan it in a way subject to some at-risk rules that allow me to offset loss from one dealership against income in another. There's also some non-permanent solutions that we can be looking at. There can be ideas around sale leasebacks or rollover leasebacks. So what we mean by that is, let's say I have a loss company in the structure that has assets and it has a significant building in it. We might actually sell that building out, trigger the tax, trigger the income. And what that's going to do is it's going to sop up some of those losses that have been accumulating. And now another company has that asset at a bumped up tax cost, at a bumped up fair market value, at a bumped up amount that we can depreciate, and it leases that asset back. So a sale lease back is one thing that we can look at quite a bit, and it doesn't actually change your corporate structure. Another one we can do is a rollover lease back. And that might be where the profit company has assets in it and the loss company doesn't have assets, but we might transfer some assets from the profit company on a rollover basis to the loss company and lease them back at fair market value terms. And we're essentially putting income into the loss company to again stop up the losses. Asset protection reorganizations are always a good thing to look at no matter what's going on in the economy. So this could be things like where we transfer assets to separate companies to protect them from the liabilities of operations. If you have redundant assets in your operating company, we should be doing a restructure to get them out of the operating company. We only want operating entities to have the assets absolutely necessary for operations, and that's just for liability protection. If you have intercompany loans or shareholder loans amongst the structure, look at getting security on those now to become a secured creditor. So now you are a secured creditor, you know, behind the bank, behind the floor plan, but ahead of all the unsecured creditors. And another one we can look at is transforming preferred shares into secured promissory notes. So what we would look at doing there is we can roll them to a holdco, and depending on your shareholdings, we could redeem them for no tax and essentially become a secured creditor because we end up with a promissory note where we used to have preferred shares. So looking at the future and what it may entail. So we have, as much as I hate the word, we have unprecedented deficits and unprecedented spending in the country and every country. So we have $343 billion deficit in fiscal 2021. That's going to be something that the new finance minister is going to be dealing with. One of the things when I asked Michelle Miller, who's our national leader of the dealership niche, what's something that would really be a stay awake item for some of the dealerships? And she had mentioned that interest deductibility. So as a reminder, this is something that we were expecting to see in the budget of 2020. So the Liberal election platform had proposed a limitation on interest expense of 30% of your EBITDA if your total interest exceeds $250,000. So this could be a real problem in times of EBITDA, if EBITDA is falling, or if EBITDA is, you know, we're in an economic downturn. So if we go down this road and interest starts to be limited, we could be seeing interest limitations. So we are going out and we are accessing capital for inventory, we're accessing capital for buildings, we're accessing a capital for equipment, and we may still be having interest limitations on it if this election platform ever sees the light of day. If we start looking at what's possible things from a tax point of view, I mentioned already that, you know, the capital gain inclusion rate is one that there's a lot of media attention around, there's a lot of discussion around. So currently, capital gains in Canada, only 50% of them are subject to tax and 50% of them are tax-free. One way to raise capital would be to change that inclusion rate and make it back to what it was prior to 2000 when it was 75% taxable, 25% tax-free. So if we're going to be seeing changes around the capital gain inclusion rate, that could be, you know, essentially what it is a tax rate increase in disguise. There could be new tax rate increases. There's been a lot of comments about, you know, the top 1%ers or the top 0.1%ers. There's been new taxes that have been floated or that have been a lot of media attention tied to. There's been comments about wealth taxes or different things like that. And there's also been a lot out there about indirect tax rate increases. So if the GST goes from 5% to 7%, or if on a provincial point, if the PST or if the HST also goes up, what does that do for spending and what does that do for your business? So that takes me to the conclusion of the actual discussion point, and we're going to go to questions now.
All right, thanks so much, Kim. So I'm going to start with you on these questions. When it comes to the federal government's Canada Emergency Wage Subsidy Program, which areas do dealers struggle with the most, and what advice can you offer them?
You know, one of the biggest things that we have seen is the complexity about the program. This program was you know, it was built to try to create fairness, but it also was very complex. And on the first iteration of the program, we had a lot of complexity around what happens with commissions, when are commissions earned, those types of things. So there was a lot of discussion, a lot of questions that came to me from our accountants that work with dealerships. How do I even quantify the queues? How do we support the revenue decline? And once we got into queues 2.0, I actually have a webinar taped on our website on that. But when you get into queues 2.0, there is all of these what ifs. What if revenue does this? What does that do to my percentage? What if? So it's the complexity is really where this has become, where most people are struggling with it.
So actually, you covered a lot of topics, and I targeted that one specifically because I knew it was a hot topic. But of all the topics you did cover, which two areas should dealers really focus on right now?
I think the two that I would focus on the most right now would be the ones that I think have time sensitivity around them. That would be the queues and making sure that we are getting all of the claims that we can get, and any kind of the debt programs that are available right now as part of the COVID relief. But then looking at capital gains, looking at, is there anything I should be doing to trigger capital gains now on the shares of my company, on the shares of, you know, whether it's on internal assets, whether it's on investments. So is there anything I should do to be triggering gains if I think that there's going to be an impending change on that?
Great advice. And now we'll move on to Steve. Steve, of the key recovery metrics, is there one that you feel better indicates how the recovery is actually progressing?
Well, you know, I'd have to revert right back to retail RO counts. We've got to get people out driving, just plain and simply. They've got to get out and they've got to be in their vehicle on this. They got to be on the roads. Once they do that, then we will start seeing the recovery that's going to stick on this. Right now, we're seeing a little bit of waves impact from items where we sold down on inventory for used cars, even new cars. We kind of brought back inventory in used cars. New cars have been a little tougher with the manufacturers being a little bit short supply, so that's going to be drug out a little bit more. And it kind of helped us on some of those other income streams being a non-customer pay. Same way with the recall lists that I mentioned earlier. We can only work those so far, and then they're used up. We've got to get people out on the roads. We've got to get them driving. Once we do that, and we see the retail customer RO count increase come back and stick and not just level out, because that's what's kind of done. It's kind of plateaued, you know, about 10-15% below where it was last year. Once we can see that improvement coming and sticking with that and possibly even get ahead of last year's comparison on this, that's where I feel the recovery is actually going the way that we want it to, and going to be around to stay.
So hopefully sooner than later.
Yes.
Steve, also, so as my second question, what are the most significant issues that dealers have struggled with when it comes to digital presence? So you did mention digital presence in your presentation, and you mentioned pickup and delivery and e-payments as option as well. So really, what do they struggle with the most when it comes to digital presence, pickup and delivery, and e-payment options, and also why?
Well, you know, there's a lot of moving parts there that they're not used to dealing with. First of all, let's just talk about digital presence, okay? We're used to our websites being kind of dictated to us on overall design, layout, and provider from our manufacturers. And the manufacturers are there to sell vehicles, and I get that. And that's our primary thing. We can't service them if we don't sell them. But at the same time, if we do a great job servicing them, we're going to get them back to buying more vehicles in the future. We got to keep them in our fold. So I think that where dealers struggle is they don't think about what they can add in for fixed operations, service specifically, in order to get that customer engaged in their website. And it's not just website, it's also just digital presence, whether it's search engines, SEO, SEM, all the things that go along with that way. How do we rank on that? How do we get ourselves better? We've got to put some effort. We have all of these employees or these companies that help us drive vehicle traffic. What we've got to do is start looking at how can we drive the service and fixed operations traffic to ultimately lead to more vehicle sales by the retention that way. So I think getting into the website and looking at your e-commerce, having a budget for e-commerce for service department rather than it just being part of their normal mailing process, email, whenever I say mailing, of soliciting customers for maintenance due, those type of things would really help on it. You just got to be willing, and to actively promote your fixed operations and service department. Again, those banner ads that scroll across, which are above the fold, meaning you can see them whenever your website first comes up, rather than having to scroll down to see them. So does your service department have any presence above the fold? We're going to have 5, 6, 7 of those banners scrolling across there. Can one of those or two of those possibly be built to drive service traffic? Maybe it's talking about the pickup and delivery. Maybe it's talking about e-payments. Maybe it's talking about contactless. Whatever the customer wants. One of the words in the title slide was, revolutionizing service and parts on this. Revolutions come from a desire and a need of a customer, and that's what we've got. Their desires of need have changed, and we've got to make sure we're changing with them. And digital is just one of the ways that they're doing it.
Perfect. Thanks, Steve. Kim, back to you. Obviously, no one can predict the future with complete certainty. And with the potential for tax changes, there's another layer of uncertainty added to the overall situation we're living with today. What advice can you offer dealers on this front?
That's right. We can't predict the future. So if I, for instance, had a gain that I knew, if I knew I had a sale that was happening in 2 months from now, and it's a certain sale, I would be looking at accelerating that for now, or doing an internal gain on it so that I could absolutely preserve my capital gain rate. Start by talking about these options with your accountants and the tax specialists, and they will bring forward some ideas for you that could help you create some flexibility in these very uncertain times.
Perfect, thanks. And now, Steve, back to you, touching back on digital again. Many businesses have struggled with digital appointments in the past. Do you have any ideas on how to maximize them?
This is something I struggled with for years in my retail days with it. And part of that goes in, I remember whenever I got my first ever online appointment, I literally took it off the printer. Yes, I printed it out and took it up to my general manager and said, hey, we finally have one. And it was like 3 weeks before we got another one. And what was interesting is we really grew that pretty quick, and it got to about 15, 18, 20% of our appointments were coming through in the email and digital presence with that. And it seems like the industry kind of plateaued there. So that's kind of the natural to people. Whenever you look at the distribution curve or the way people accept technology, that's kind of the early adapters. But the mass majority hasn't even accepted this, and this has now been 20 years on it. So it's time where we need to have that mass adaptation. So I think getting in there and making sure that the appointment system is set up easy to use. It's got to be intuitive for the customer. It's got to be very easy for them to get to and use. We as a dealership have to show people whenever they're buying their vehicle, we should be having them set their first service appointment at the time of purchase on our digital platform in our showroom or at delivery or at their house for delivery. Whenever we have apps, a lot of the appointment schedulers have apps that can be put on their phone. We want to install that for them. Ask for their permission, install it for them. Whenever people come in for service, we need to be telling them, hey, I saw you made your appointment. You called in for your appointment on that. Did you know we have this available 24/7 digitally? And we even have an app for that, and letting them know and having the signage and the website and everything saying 24/7. People like convenience. And if we can keep saying, we're not doing this to make it easier on us to reduce our inbound phone calls, and which does, but what it does is we're doing it for you. We're doing it because this is convenient for you. You have 24/7 access. And if we can really adjust our schedule for our staffing, adjust for work schedules and vacations so that the appointments in there are true appointments, and we can offer the first available appointment we have to that customer and they can utilize that, they will go to it. It's whenever we have it locked down for 3 days and they can't get an appointment, then they're picking up the phone to call anyway, or they're going somewhere else. So we've got to get better at the way we handle it. And then we've got to push it in front of the customer on a continual basis and just get them used to it. And once we do that, we'll have mass adaptation for it.
Good advice. And so in that case, before we go on to Kim for the last question, I want to take a moment to remind the audience that if you have any questions, now's a great time to include them in the Q&A section at the bottom of your screen. And if you can't find it, you can just scroll over it with your mouse and you will find it. It'll pop up. So while I ask this last question, I would encourage everyone, if you have any questions, to take the time to write them. Kim, my last question for you is, how can dealers best protect their dealership during this difficult period, and what steps does it involve taking?
This isn't what I'm here to talk about, but again, be relevant. And I'm going to echo, as a consumer, I really enjoy when I get to what Steve had just said. I had to go into the dealership lately, and I used the online portal to get my appointments, and I really appreciated that. But in terms of best protecting the dealership, I think one of the things that we need to do is make sure that we are having an ability to get the best tax advantage and the best cash flow advantage that we can. So whether that be looking at the structure to make sure that I can use losses within the group, whether it is to find a way to put profit into entities or put revenue into entities with losses, whether it is a way to remove assets out of loss companies, or even just overall changing the structure. And again, the first step is going to be to have a chat with your accountant, your lawyer, your tax specialist, and we will help you walk through that and look at a bunch of options and what's the best for each fact pattern. Because you might even have 3 or 4 companies in the group that all have different issues, and we'll be doing different things with each one.
Absolutely. Well, thanks, Kim, and thanks, Steve, for taking the time to offer these presentations, and thanks to the participants for tuning in. I don't see any questions at the bottom of the screen, so with that, I hope everyone enjoyed the presentations, and I wish everyone a great day.
Thank you very much.
Thank you very much.